volatility tsunami, and I made an indicator with the data in that's really good. But he's got one on his subscription data that's even um, more accurate from like a timing perspective. Definitely great analyst. It looks like we're starting to get a few people. We'll probably get a few people that join as we get going. I know sometimes the weeknights could be so still trying to figure out like a really good time for to accommodate as many folks as possible. But so we'll go ahead and get it started and then
Sure.
let people trickle in. So yeah, thanks everybody for joining. And so for anybody who might be new, I'm Ben, and I do the it's all in the Reflexes Substack newsletter, and then you can also find me on X. And then this is the first time that we're having a guest analyst join us, and I'm super excited to have Sonny on. I've followed Sonny for a long time now. He's just a great analyst. He's real strong with Elliott Wave. Brings like a cross asset approach, which when you do like the CMT training and stuff, they educate on cross asset analysis and the importance of it. But even folks that have the CMT, I see them kind of get away from that and just kind of go with a single asset class sometimes. But
Hmm.
there's like a tremendous edge if you can um, understand how funds flow from one asset class to another. And then somebody else does great work on cycle analysis. So we're just real excited to have him on today.
Thank you, brother. Excited to be here.
Yeah, excellent. Is there anything else you'd like to add as well?
No, just really, yeah, it's super. I love these kind of things because it's also helps me. It's not just an opportunity for me to share my ideas. Like in the process of doing these things, I'm refining my ideas in that process. So really helps me just kind of sense check my own thesis, my own ideas. So yeah, I really appreciate your kindness and inviting me on today and just see what you guys think. And I think it could be very complimentary, as I've said to you before. Is like you have a very I love your style because it's very data driven, very objective, and it's probably something. It's a weakness of mine, to be fair. Like something I have to work on is trying to be a little bit more objective because my gift and my curse is my creativity and my intuition. So it's like finding that balance in between being creative and intuitive and with a cross asset kind of perspective, and then also kind of learning from you. I've already learned a lot from you about how to just build a system and stick to data and be a bit more objective. So as always, yeah, we're always learning, and I'm still just refining that process. But I think I've got some really interesting things to share today. So looking forward to
Yeah,
sharing.
awesome. Yeah, that's great. And so I'm going to touch on a few of the market timing signals. I've got some econ data points that might be interesting that I'll probably save until till the end, so we don't take up too much time. And then I'll show a little bit of seasonality and cycle data that I'm allowing to shape a bit of a bias for me. And then we'll turn it over to Sonny to go through his approach and charts. And then, but to echo what Sonny said, like I get a tremendous amount out of the questions that we ask and the things that we talk about on these calls. So if anybody's got a question or something that they want to contribute to have us take a look at, just interrupt as we go and we'll jump in and do it. But so to start off, I always like to do a couple of quotes, and this is one that Arit Trading shared a couple of days ago, maybe a week ago on Twitter. So we've done like a really great job, I think, taking these signals and navigating the downturn, protecting wealth where we could. And so that's only step one. The next step is to identify identify the confirmed bottom in the move and reposition ourselves at the right time. But what happens is these types of markets get like really fucking boring, and sitting risk off is not a lot of fun, or smaller sized tactical trades can get boring. So we don't want to sabotage ourselves out of boredom, and so that's why we'll just keep taking an objective look at the data, look for evidence of a bottom. And then And two quotes today. So Maya Angelou is she's a civil rights activist and a writer, but I love this quote, and I feel like it can apply to just about anything in life. And it's exactly what we want to do here. Is we're going to do the best that we can, and until we know how to do it better, and then once we know better, we're going to do better. So we'll just keep improving every week. And oh, you know what? I paused the recording. I'm going to turn that back on. Let's see if I can find that real quick. Nope, I'm recording. Okay. Just want to make sure I didn't miss anything. Um, all right, so taking a quick look at trend for the S&P. So we had a nice bump up today. I grabbed the screenshot a little bit before the close. Looking at a few things on here, we've got the lowest green line is the anchored volume weighted average price from the 2022 low, and that's where the drawdown tested and rebounded, and we had that large range candle shortly after. So on April 3rd, we've got the some orange vertical lines that start, and then a thicker orange anchored VWAP. So it's orange for Trump. This is the art of the deal anchored VWAP, and this is the day that those tariff posters came out and the market had its reaction. So this is what market was already drawing down. We already had our 5% drawdown signal that we were taking action on, and then this comes out and it derails an attempt at a recovery. And so I'm anchoring a GAN timeline to it, and I want to see if the sentiment is influenced. Our goal here is to see how long sentiment is influenced by the tariff news catalyst, and so we've got a new green anchored VWAP on the low. We're monitoring our one from the all-time high. The last retest of the all-time high was on 327, and now we've reclaimed that and we're holding it as support. Evidence that I look for reclaiming the uptrend is I'd like to see 2 to 3 closes, like full candle body closes above the 0.382 fib level, which is starting to coincide with the AVWAP from the all-time high. Now it's normal for us to overshoot it and then come back and test it. That would be really strong confirmation that that we're headed in the right direction for my trend following process. Sometimes it will shake out a little bit in between now and then, but that's okay. And I'm going to rejoin trend anytime we're reclaiming that level. The anchored VWAPs are aligned into some interesting time frames. So I'm sorry, the GAN time zones. So number 25 falls on May 7th, and then the next one is May 22nd, and there's another one after that will be time zone 49 comes in at June 11th. So those are if this is an event that's continuing to influence sentiment in the market, we'll probably see pivot points align closely to those dates. If we're not, that tells us that the market is finding, is responding to influence somewhere else. Taking a look at it from an intraday standpoint with a GAN box, anytime that we're below one of these 45-degree angles, whether it's the ascending or the descending, we're generally bearish. And what we're seeing, this is a 1088 session GAN box that's proportionally drawn. The square root of 188 is of 1088 is 33. From a numerology standpoint, 33 is a number that signifies monitoring for more information or looking for direction. So the proportions from high to low drew a 1088 session GAN box, but it's interesting that comes back to that numerology. So we're reclaiming the descending 45-degree, and you can see where price is starting to run into a little bit of resistance right at the 50% mark. GAM's always really big on when we have a 50%, either from a time and price perspective. That's usually where we start to see pivots and shifts in price, it reflects a decision point for the market. So the anchored VWAP from all-time high is starting to run into alignment with areas where we have intersections between the ascending and descending angles. And this is a busy chart because of all the angles that are in a GAN box. But that tells us that we're probably going to see a little bit of indecision and probably some tighter ranges of movement as we get into these series of boxes than we do in the faster paced descending and ascending lines that we had earlier into the downtrend. So it speaks to potential for a bit of consolidation. Um, Taking a look specifically at, well, and before we move to the timing signals, you notice that my favorite sentiment cycle pattern is the market's starting to look a lot like that, right? You've got, your maybe like your anxiety and um, despair. Like you get your despair and panic down, you get into anxiety, a bit of aversion, and then we're possibly coming back up into into the area of like disbelief, right, or denial. So it's possible that this happens a couple of times. We might still be in like the despair area and then working up into wall of worry and anxiety into that anchored VWAP. But that's the behavior that we'll look to see is this break above retest and then a springboard from there. From the weight of evidence approach, we've got a bit of a different look than we had on the early part of April. So this was the April 3rd was like the worst that I've seen it, where we had seven red signals on these indicators and only three yellow. Now we're down to like six red and one of them is even flipped to green. So it's things look better than they do, but this is definitely not out of the woods for us yet. Um, Only going to focus on a few of these, but the number of companies in the S&P that are below the 200-day moving average has started to come down off of a high. We want to see about like 85. I'm sorry, we want to see about like 55% of the companies in the S&P above their 200-day moving average to be comfortable that we're seeing a broad market recovery. Until then, it's for me personally just tactical trades until I see a very broad participation in the market. Um, this is busy because I tried to squish it in a little bit to get enough of these signals, but the volatility weighted put call ratio, mathematically, this is a combination of put call ratio, price volatility with ATR. It uses the VIX of the VIX, and Larry Williams' VIX fix formula. So we're trying to cover every base that we can to measure volatility because any one of those signals in isolation can produce false positives and anomalies. So when we combine them together and then we use like a stochastic and an RSI formula with them to smooth, we get this volatility weighted put call ratio. And the way that I use this is a break below the Bollinger Band tells us that we're going to see near-term volatility in the market's positioning itself for a change. A larger drawdown doesn't generally occur directly from that signal. They tend to occur afterwards. And I've never really used this as a risk on indicator. But looking at it more closely, we see in instances where we've broken below the -80 line on this indicator represent an extreme in the put call positioning. And then when it recovers back into its moving average cloud, that's generally bullish for the market. But when we see like a kind of like a double tap, right? You have an extreme low and then a higher low, and then a recovery back into the moving average cloud in conjunction with the composite momentum model. And this is a scoring model that looks at momentum of S&P, Dow, and Dow Utilities. So we're going from negative to positive in the momentum model at the same time that the put call ratio is confirming a higher low, and then returning to its moving average cloud. There are four prior instances on this screen, and then if we were to look at all of the prior data, there's maybe like 8 to 10 in total. So it's small sample size, but they they tended to mark the bottom. And so we need to be open-minded to having potentially seen the bottom. My bias and some cycle analysis and seasonality tell me that we likely haven't, but we want to stay open-minded to what the market is showing us. So that's probably our first evidence that first evidence to introduce a case for the bottom being in. The next is the extreme vulnerability indicator. Looks at the number of days that we've gone without an extreme low in new lows, and this got up to 139 consecutive days where new lows in the market did not reach an extreme low of 0.325% or less. That's the second highest since 2008. And in prior instances, this didn't always cleanly mark the low when we saw it reset. So we have to be careful with this one. They don't all look like 2022, where we now, immediately go on to a lower high. I do this all the time, where we get into a lower low. Um, some of them it marks the low, some of it sometimes we see a higher low, and then a recovery, and sometimes it's like a retest of the low. What we're going to do is look at this in conjunction with the middle indicator, which is the advanced decline line divided by its 32 session moving average. And when we look at that with the Bollinger Band, if we're going to need to see this advanced decline line divided by its average continue to move higher. And if it too soon within the reset of the extreme vulnerability indicator, if we get a break below the lower Bollinger Band of it, that tells us that more lows are coming. In prior instances where this indicator marked the bottom were times that the advanced decline line divided by its average did not break below the lower Bollinger Band within 1 to 2 weeks afterwards. So that'll be strong evidence that would again sway us towards the possibility for having seen a low. Looking at so there's a few breadth measures. These are going to be really helpful for identifying whether the market's return to risk on or still concerned about risk off. So the cumulative new high, new low is still below its moving average. This is the 50-day moving average of it, which is bullish, or I'm sorry, which is bearish, right? We've got a higher low in the S&P, and so we're angled upward there. Our volume, NYSE volume, is still climbing, which is bearish because it's climbing into a downtrend. So this is still signaling risk. And we've got a bullish crossover on the rolling new high minus new low. And this is a 10-period rolling accumulation of new highs minus new lows. So this, on the surface by itself would look bullish, but then you look back to 2022 and you've got the same scenario. You've got your new high, your cumulative new high minus new low is below its average and it's flattened out. And you've got a higher low in the S&P. You're still below your 325-day moving average like we are now, but you've got your higher low, your NYSE volume starting to level off, and you've got a bullish crossover in the rolling new high, new low. So this looks strong for us, and we have a nice movement upwards right after we see it, but it's not the end, right? We run into resistance at that trend line, and we fall back down to a new low. So this, again, I'm open-minded to having seen the low, but this is not convincing enough for me to say I'm ready to go risk on yet. Now, the ultimate, right, is these capitulation oscillators are a combination of mathematical combination of up and down volume and companies advancing versus companies declining. And one's on a short time frame and the other's on a long. So we just barely get into the extremity of the long-term capitulation oscillator. A lot of times these don't signal a low until you've done it like twice. And now it's coming back up towards its upper Bollinger Band. So if we get a break above that Bollinger Band, you typically don't see that when another low is coming. So this could signal that we have seen a near-term low. The short-term capitulation oscillator can be really misleading. When it gets below the yellow, we're in an extreme area for the market, and we're likely to see more downside. Normally, the best indication that I get from this is when we see a second higher low, and that tells us that we're marching towards a recovery. This is moving pretty steeply after just touching the extreme level in the long term. So this tells us that we may not have seen enough activity to really exhaust those that are willing to sell into the market. Now, this is a good quote that I saw from Cycles Fan, and he's responding to somebody that said, "Hey, there's no fear in the market," and he's saying, peak fear occurred in that April timeframe when we saw the extreme low, but the bottom of the move on lower volatility can form within 5 to 8 weeks. And so if we come all the way back up and look at the timeline, right, you've got your peak fear event going into the anchored volume weighted average from the 2022 lows. And then if we look at 5 to 8 weeks forward from there, that's lining up really closely with the May 7th, May 22nd timeframes, even getting towards like the June 11th. So just something for us to be aware of. It's a good observation that we typically I see the low of a movement, um, 5 to 8 weeks after peak fear, and that aligns with what we're seeing in the sentiment cycle from Gann. Um, other things for us to have on our radar and things that might be influencing the market towards volatility and a bit lower. We know that we've got a lot of the nation's debt in the U.S. Maturing. Uh, Roughly a third of it matures within a 12-month span. I took these numbers from the second week of April. So some of it has rolled over already. About 25% matures before September. Now we've got on the screen, we've got the US 10-year price on the top, and then the interest rate, the yield for the US 10-year on the bottom. And we know that yields and price for treasuries have an inverse relationship. What you notice is like you'll have a more extreme wave impulse on either the price or on the rate, but they generally don't have an equally extreme movement together. So we've had a gradual movement down in rates and a strong movement up in price into April, and this suggests that we're going to continue to see gradual downward pressure on price in longer duration bonds, with potentially a more dramatic upward movement in rates. And this isn't an actual forecast on the rate, just a forecast on the direction of the move. Again, we've got, I'm using two time frames on here. I've got the Gann timeline, which I'm starting to get away from Fibonacci timelines and working more with Gann time zones because of the stronger consistency with pivot points. And I'm anchoring it to a confirmed higher low in the US 10-year at the end of 2022. And that aligns pretty tightly to pivot points that we see in the price for the 10-year. Then we're anchoring the Fibonacci time zone from the swing high to swing low from A to B in 2023, or I'm sorry, at the end of 2024. Where these get pretty powerful is when you see two of them in confluence with one another. That seems to be the strongest suggestion of an impending pivot, and those appear the next time zones we've got again like the very end of April. So we're kind of like approaching a pivot area, and then the next ones will be like the end of June and the beginning of July, to like mid-July. And that time frame happens to coincide with the next, the extended deadline for the tariff negotiations, which could move. But we know that this is a time frame seasonally where the market has some challenges. It's typically the July is the summer rally in the market, and then we start to have those rough months in August and September. That's coinciding with a pretty big portion of treasuries maturing and rolling over, and that whole tariff battle. So this is like kind of a confluence of news cycles and influences. Um, I shared the Williams 37-year cycle in a couple of updates ago on the Substack. Um, what's interesting about this is he published this in 1986, and extending it out in this fashion, we can see that it's lined up very well with some key turning points in the market. On the right, we've got the 56 and 20-year cycles, and I'm sharing this one in a fixed method. There's another one that's gives a little bit of variability that helps it stretch into like the 2008 recession. But in this case, I'm like my preference is to show it fixed along with the fixed Williams. Um, so Williams has three phases in the 37-year cycle. There's the 18-year phase is the longest, and you've got two pronounced lows that occur in sequence, two pronounced highs in sequence, two lows in sequence, and then you have a peak and a drawdown into your phase two. Phase two is the shortest, and you can see that we're entering what would be phase two, a trough as a beginning, which we're likely to see throughout 2025. And then that anticipates a multi-year movement upwards before the end of phase two into a bear market. Now, phase three is his quote from the book was something like, this is the phase tops of phase three have produced the largest debacles in U.S. equity markets. And so why I point that out is, we're concerned with this tariff war, but a lot of economic conditions remain pretty strong. There's liquidity in the marketplace that it doesn't seem to be quite reacting to yet. The tariff issues are self-induced and can be largely resolved as quickly as they were initiated. So that suggests to me that the things that we're seeing now were to be expected, but that they're not likely to be you know an absolute crisis like a recessionary low or something like that. When we look at the 56 and 20 year, you've got the housing peak in 2005. You've got the takeover peak in 1985, which was uh, like the peak of hostile takeovers in corporations in the U.S. in 1985 that was really disruptive to markets. 20 years from the housing peak, you've got the tariff war that we're in now. The middle of this cycle, you've got the formation of NATO, the establishment of the People's Republic of China as a communist party, and the start of the Cold War with Russia. So it's a lot of things that we're kind of revisiting politically right now, and then taking 56 years from 1985 brings us to a turning point in 2041, which would coincide with the top of the phase three of the Williams cycle. So just good confluence for us to be aware of. There's probably a larger risk event much further into the future than the one that we're facing now. The one that we're facing now could contribute to it, but this cycle format would suggest that it's further away. And then to take a look at a more tactical seasonality. I'm big on the annual seasonality in the presidential cycle. We've got we're exiting the last month of what is normally the best 6 months, and we're walking into like the worst month of the first month of the worst 6 months. April is normally a strong month for the best 6 months, and it is sucked. And July is normally the strongest month in the worst 6 months, and we know that we've got some catalysts coming up in July. So I would normally take some tactical trades to trade into July strength. I'm avoiding that personally right now because I just want to see how some more of this plays out. And I just don't like the additional layers of risk with more like market manipulative events in front of us. And then if anybody wants to screenshot this is my seasonal playbook and what I'm currently doing with it now. So normally I would hold Apple and start to sell it into the September and or sorry, I would start to sell it into July and August. I'm already out of that one. I've added Procter Gamble onto the seasonal playbook because April and May are such strong months to add it, and it tends to have a really nice 6 month run. It also thematically, if we see tightening and concern from the market, it's likely to do really well when the market starts to gravitate towards consumer staples. So I'm still in that one. I would normally do semis right now. I would normally do the tech sector and then sell into strength in July. I'm passing on those. And I would normally be rolling a lot of my capital into Treasury ETFs right now. And I'm only doing like SHY and SGov because they're very short duration Treasury ETFs and not likely to see capital erosion as likely to see capital erosion as like say the 3 to 7 year Treasury ETF or the TLT or the 7 to 10 year one. And then at the very bottom, we've got the annual presidential cycle. And so what this calls for, this is from the Stock Trader Almanac guys are really big on this, and it's a pretty well known cycle. So you get into year one, the post election year is where you go 6 months on, 6 months off, and you go risk off in from May to October. You use a momentum crossover to come back into the market in November, April. Then you do the same thing the midterm year, but when you come back in the midterm year, you're safe holding long-term positions through the pre-election year and the election year. In the last two presidential cycles, despite the strong difference between the political parties and the candidates, that strategy was a real winner. So I'm running this right now, and I'm like I said, I'll have some tactical trades, but as far as risk on, I'm really looking for probably the fall time period is what aligns best to me. Uh, so that's my quick run through of things, and I think it's a good place to turn it over to Sonny, who's got a number of charts and some additional perspective to share. Um, but I'll also pause there. Like, does anybody have questions about anything so far? All right. All right, Sonny, it's all yours. And I'm looking at can you see the results of the poll?
Let me check. Where was it? No,
Okay, so
I don't know where it's gone.
yeah, I did for the Elliott Wave poll. So 80% of the folks have a little bit of background in it, and one person said, "Hell yes, they have a lot of background in
Cool.
it." That wasn't me. So
Perfect. No questions. I'll get started.
yeah, go for it.
Awesome. So I was going to start with broader picture and then dial it in, and hopefully by the end of it, I'll leave everyone with something that's actionable. But yeah, I'll just kind of give a brief introduction to my background and my journey briefly. So I was my last professional role was for a hedge fund in London. I was doing the legal and compliance team for a hedge fund in London, and yeah, really sort of cut my teeth there in terms of developing my financial literacy. So I think naturally from that experience, I have a very macro perspective. And yeah, learned a lot about different strategies and et cetera through that. They shut down their business during COVID, and then I went on a little bit of an adventure, just trying to figure out what I want to do. And I knew it was always life was always guiding me to a more independent, free lifestyle. And I realized that if I've got the bravery to embark on this journey, then this could be something that fulfills me in not just financially, kind of spiritually, as well as giving me that independence that I was looking for. So I went into trading my own personal account, and I've been doing that full time for about 18 months now. Um, so essentially, how I'm going to start with how I kind of view the system itself, and then go through that kind of perspective. This quote I've got is going to really kind of permeate the whole presentation. So this is from Hyman Minsky, and he says if the use of Ponzi finance is general enough in the financial system, then the inevitable disillusionment of the Ponzi borrower can cause the system to seize up. When the bubble pops, i.e., when asset prices stop increasing, speculative power can no longer refinance or roll over the principal, even if able to cover interest payments. As with a line of dominoes, collapse of the speculative borrowers can then bring down even hedge borrowers who are unable to find loans despite the apparent soundness of the underlying investments. So, when understood from this perspective, the entire system is based on credit. It's based on debt. This is why they try and keep things in that Goldilocks zone of 2% inflation. They just want enough inflation to keep the ball rolling, to keep things ticking over. Too much inflation kicks things out. Deflation really causes problems, as they say, as he says here, because the deflation just makes the burden of debt insufferable, and that's when you get credit event. If you look at any disaster, it's a credit event of some kind. So with that in mind, this is the theme I'm working with at the moment, and I think when we understand this, it can present an incredible opportunity to understand this cyclical nature between inflation and deflation, especially as it's becoming more volatile. I think we're all seeing that in markets right now. You're getting shorter, faster cycles as this volatility just increases between these bouts of inflation, and then it whipsaws. And my thesis is we're about to whipsaw back in the other direction into a very severe bout of deflation, which I actually think will cause a credit event probably in Q3. I think we're on borrowed time at the moment.
Sonny, I think it's still on my slides. Do you have to put your screen share back up?
Okay. Can you see that?
There
Is
we
it
go.
back?
Yeah, there we
Okay.
go.
That's because I full screened it, I think. Okay, there we
Gotcha.
go. I'll go from here. Cool. So that was the quote. So with that in mind, I very much from the top down kind of approach to markets with the starting with the bond market. Everything's coming from the cost of capital, and the bond market is indicative of financial conditions. So we can learn a lot from understanding, are we risk on or risk off. As you can see, we had this massive increase in 2022, 2023, which really caught everyone off guard. And it's just such a beautifully clean Elliott wave structure. It's almost textbook. So once I started to see that, I could see that there was an incredible opportunity coming back into this wave two correction. And it's actually when I started trading, I could see over here that it was topping out, and it had quite a clean 5 wave impulse. And I think this A wave here was it set records at the time for the rate of change for going from financial tightness to loosening financial conditions. It was a very vicious snapback rally that happened when the Fed paused back in October 2023. And it was at that time as well, I could see on the high time frame, Bitcoin was going to break out. So that's when I really thought, after doing about a year of study on technical analysis, I thought this is probably my best opportunity to join the market. And it was an incredible opportunity because that impulse from till December was when everything really went crazy, and it was actually dangerous because I thought I was much smarter than I actually was, but that's the nature of it. So this is my perspective. This is my count on the US 10-year, and we're now starting to roll over. I know a lot of analysts, a lot of macro talking heads have been talking about how this is a basing pattern, and it well could be. I'm not saying this is 100% right, but it looks indicative of rolling over, and it's kind of luring everyone in as it does that. And I mean, the macro is supporting this as well. We've had the last PPI, the last CPI print were deflationary, not just disinflation, because disinflation is good for markets, but deflation is their biggest fear, especially Powell's biggest fear. So the macro is in support of this. It's happening. And as you can see, when I switch to the next chart, which is GSG, which is 65, 70% oil, you're looking at a mirror image, really, if you just flick between those two charts, it's identical, right? Which makes sense. The oil is really driving the inflation. That's where this inflationary spike came from. It came from oil. So we have a very similar pattern here with Elliott wave, a really beautiful B wave in this triangle formation here. And what I'm suggesting is coming is this 5 wave impulse down here. So we already got that breakdown. This big red candle was Trump's art of the deal, art of the disaster, whatever you want to call it. And then we're bouncing on this trend line. But once this trend line breaks, this is going to move very fast, in my opinion. And that's going to really precipitate yields falling, reactions from the Fed. I'll just go back and quickly say something on the US 10 year, because I think this is the opportunity here, in my opinion, this third wave. Wave 5 is probably going to be a disaster of some kind. This kind of they'll be piling into bonds, in my opinion, as a real risk off move, because deflation is obvious and they need a safe haven. So the tradable event here for me is wave 3, which is going to be the repricing of assets, of interest rate sensitive assets, which have been laggards, which have been suppressed because of these restrictive financial conditions. So that's the essence of my thesis, if you like. And just to flip it on its head from another perspective, this is the international government inflation protected bonds on a monthly chart. So just like to see things from different perspectives, because Elliott wave can be a little bit subjective. So I'm trying to look at things from many different angles to try and find confluence for my ideas, because I don't just want to make a count and start and make a bet just based on an Elliott wave count. So for me, this is a really beautiful bottoming pattern you've got here. It's on a high time frame, monthly bullish divergence, and then you've got these 3 drive pattern, all these wicks in here. So this is suggesting me that you're at least going to revisit this 42 zone where there's a lot of demand there. So this is the international inflation protected bond. So we're looking for a bounce back. Bearing in mind this was the inflationary bout here where they really collapsed, where yields rocketed out. So that gives me a nice bit of confluence that this is not just unique to the US. This is we're looking at the global financial system here. So now tying it together with how do we use this information? How is this useful? So I look at HYG every day. It's a great barometer of risk on, risk off. And here just looking at the relationship with small caps, they're very sensitive to inflation, and they're very sensitive to financial conditions. Obviously, they for just on simple reasons, for inflation, if inflation is high, obviously it eats into their costs and their margins. It's not good for them. But mainly the increased financial conditions is disastrous for them, because they depend on the availability of credit. So they don't have access to capital markets the way Apple, Facebook, and the Mag 7 would do. So really the availability of credit is their lifeblood. So you typically see them do really, really well when we were in the ZERP regime, or rates were very low and inflation was low. Go check out my Twitter for a bit more detail on that whole relationship. I won't go too much into it now for time, but in essence, IWM depends on easy financial conditions, and when these conditions are tight, you do tend to see them falter and stumble, which is exactly what we've seen in this bull market the last few years, right? S&P, NASDAQ have performed really well, and everyone kept betting on IWM, and it never quite came to the race. So, but I do think that's about to change right now. I'm so glad this meeting happened today and not yesterday, because this chart is so much better today than it was yesterday. So it's not confirmed yet, just to be completely honest. We've still got just under a week left for the monthly close here, but this is setting up to be just one of the most beautiful bear traps ever. I posted this bull flag at the end of March, and we had obviously this absolute disaster beginning of April with Trump, and I was positing at the end of March, like we're about to go full risk on. because this is just a beautiful high time frame bull flag, and then you got this volume gap here, and you can see it works both ways. You can slice straight through this thing, or you can rocket straight through it. You can see here this coincides really nicely with risk on, risk off moves. So, if this a close, if we get a monthly close down here, you're looking at a credit event. Your credit's going to seize up. There's going to be a real risk off moment and disaster. But it's just shaked everyone out. It took out the lows. The wick took out the lows, and now we're coming back up. And if you close as a hammer or a dragonfly inside the bull flag, wow, this is my chart of the month for me. If that ends up closing within the bull flag, I think you get massive confirmation that was a fake out of a credit event and took us right to the limit, and then fully reversed as everyone realized actually nothing broke. A few hedge funds blew up because of their basis trade, but other than that, everyone survived, and we can move on from this. So this ties in really nicely with my high time frame Elliott wave account, because this on the surface here, this count looks extremely speculative because I'm predicting a corrective wave. So those who are not too familiar, the wave one is a motive wave, the wave three is a motive wave, and then the wave five is a motive wave. So this is a trend. This is an established trend with real structure. Then you get the corrective moves in between. So you get the ABCs here on wave two and four. And in any wave, it's a lot easier to count the impulsive motive waves, but it's a real mess trying to count corrective wave because it could do whatever it wants. So on the surface of this C wave looks highly speculative, and it kind of looks unreasonable. That's why I'm trying to give you some perspectives from different angles to just try and paint this picture. So the 1.618 extension of the A wave here is what you would usually find the C wave arrives at. And so what I'm positing here is that there is a vicious snapback rally coming for IWM due to the bond yields coming down, due to the high yield going to be going up with financial conditions easing, and it just times in really beautifully with these cycles as well. You can see how these cycles have played out perfectly, and they've all been right translated essentially. You've had all right translated cycles, and then this would be perfect as cycle theory. You get three bullish, and then the fourth one this would be a left translated cycle indicating the bear market is coming. So I'm yeah, this is something that I'm following very closely, and this chart was posted 2 weeks ago, actually on the 7th when we had the crash. So I was going out on a bit of a limb here, but I was just seeing many things to confirm this from all the things I'm presenting to you today. And as we speak, the weekly has now recovered this trend line, which is a good sign. So I do think it is in a secular bear market, along with the bonds. Bonds are in a secular bear market with entrenched secular inflation, and I expect this to be a very vicious bull trap, essentially. So as we get up to here, I wouldn't be surprised if in Q3 there is a real disaster and this falls apart very quickly. But I think this move is the opportunity, and that catch a lot of people out because I really don't see anyone talking about this. I don't think anyone is expecting IWM to have this snapback rally in the middle of all this disaster. It makes no sense to normal people logically. Tariffs hurt small businesses, etc., etc. But when you understand the macro forces that are driving the flows, it does make a lot of sense. Financial conditions are going to ease. That's going to increase global liquidity, and typically IWM performs really, really well when we're increasing liquidity. So one of the biggest components for IWM is the regional banks. And this make the fact that they would start to perform now obviously ties in nicely with what I'm saying with the US 10-year, because the yields are going to drop. That's going to give them much more leeway on all their unrealized losses on their books, on their bonds. It's going to make their balance sheets look a lot better. and it will also improve all their commercial real estate as well. So just noticing here that this week it is currently, I've noticed a lot of strength this week with KRE in the market. So it's the stock RSI is trying to break out here. We IWM really needs KRE to perform, given it's such a heavy weighting within the index. This was the biggest confirmation for me to what I was seeing was the small cap growth versus the small cap value, and it was one of those moments where I just went, "This is super interesting." So we had that April 7th. This is from last week. This is last week's candle. We're having a bit of consolidation this week, but this candle here was green on the week of the tariffs, and I saw that on during the massacre and the bloodbath that was happening in the market. And I just had to step back a little bit and ask myself, why on earth is money going into small cap growth versus small cap value if we're about to go into a recession, if tariffs are going to cause this big disaster, if there's going to be a credit event? There is no way you would be positioning into small cap tech growth, broadly speaking, if there's going to be a big disaster. And then so last week we got this really beautiful confirmation of this breakout here, and currently we're just consolidating after what was a pretty big move. But for me, this was a signal under the surface that institutions are positioning for risk on, but in a very specific sector. So then I'm watching a lot of these ratios in between the indices, and then we got this beautiful reversal last week with a Marbuzu Black three drive pattern. Not shown here was the bearish divergence on the daily too. This is the weekly chart, but yeah, we got a really lovely divergence into this, and very interesting again. Showing IWM is now potentially going to start outperforming the Nasdaq, not generally something you see in a risk-off environment. So I was starting to think these things are not really adding up. The headlines I'm seeing, but the technicals are telling me a different story. Just another perspective from the same ratio but inverted. So IWM on the top is showing you this is on the monthly, and I really love these patterns where you're just getting these wicks down here on the monthly. Again, three drive pattern. So there's some absorption here. And this looks like, a double bottom to me as forming here with this free drive pattern. So looking at small cap growth versus the Mag 7, we've got a very, very similar setup to the end of 2020. And this was a very strong risk-off move, and this has been building for some time with this divergence, as you can see, and this divergence has just got a lot stronger. You see the rate of incline. This one was building here, and then you've got this move here, which is just the end of it here, which suggests to me that this is really worn out now. This trend, and especially retesting this downward trend line as well. So this tells me that we've got some imminent outperformance within small cap growth. And then you go back and compare this to Bitcoin, which is fascinating because this move here perfectly mapped onto the most aggressive parabolic move of Bitcoin. You could take this peak and it exactly lines with the peak here of Bitcoin. So it makes sense, right? Bitcoin, similar to IWM, is a kind of liquidity junkie. So once the financial conditions ease, once the global liquidity increases, that really gooses the market, and suddenly capital rotates out of the leaders and comes into these laggers, these more speculative assets. Whether we like it or not, Bitcoin is in the eyes of people, the narrative is it's a speculative asset. Maybe that will change one day. I don't think it's going to change anytime soon. So similar thing with comparing it with Bitcoin and crypto. So when you get the monthly break above the cloud on the small cap growth versus the small cap value, that initiated a really big impulse for Bitcoin and the crypto market. So you can see these moves lined up, and it actually gave you a really good signal that it was probably coming to an end with this divergence. You weren't getting the follow through here on the ratio between the growth and the value, but here you're making higher highs. So it was, you could even use it to just sense check how frothy we are. Is this move still justified? In hindsight, this was a really nice divergence that could have told you actually time to go back to risk off. Maybe we got a bit extended on the risk on. So this is my play for the next few months. This is my focus. Very specific risk on sectors, which for me would be the Bitcoin miners, Bitcoin itself, and the crypto market more broadly. As you can see, once IWM started to outperform the Nasdaq at this part of the cycle, that was when we saw really, really aggressive moves up in Mara, others, and Bitcoin. Um, and just from a macro perspective, it seems to be lining up perfectly with what I've been saying about the US 10-year, oil, deflation. So I think that we're in a very unique situation where there's going to be kind of like a dislocated market almost, where I don't really expect the S&P to do fantastic, or the Nasdaq, as you highlighted really well. I wouldn't be surprised if the low is not in either. But we're probably going to get a peak euphoria in certain sectors like IWM and Bitcoin, as that money rotates out of the Mag 7 and finds a new home in these laggards that have really underperformed the market more broadly. So I'm looking at a similar time window as you, in regards to probably takes us to June, July, and then I think the reality sets in the summer with when this deflation actually becomes a real problem and actually stresses the system to the point where there's probably a credit event, and then who knows, the Fed might step in and have to help and use their tools to try and stabilize the system, because deflation's it's going to have terrible consequences. But I think there is a small window of opportunity, as everything gets repriced, as the system loosens and that liquidity comes into the system. And yeah, so that's really my focus for the next few months.
That's great. Are you doing anything with small caps?
I've just started looking at a few of them. Yeah, I wasn't going to include them. Just didn't know if they would have enough time to look at specific names. I did send you. I think I sent you a couple of names that I caught my eye last night, and it's interesting if you go through that ETF. Like the types of things that look really strong are not the industries that you would expect to be strong if we were going to have a recession or something like that. There's a lot of industrial stuff, specialized industrial equipment. A lot of the software names look good, but there was a lot of restaurants and things that was what really shocked me. A lot of strong consumer names, and given where we are with all these consumer sentiment, the Michigan consumer sentiment all-time lows, it's quite interesting that yeah, it's looking at those names, it doesn't tell me that like an immediate recession is coming. I do potentially think that is coming, but I think people were getting their timing a little bit off. I think it's not quite yet. They just called it a little bit early with a recession.
It's tricky with the sentiment measures too. This close to there's my all my alerts going off at once. It's tricky this close to the political change, distorts some of those surveys a little bit. Like people, be more fearful
Definitely.
of the future, but they haven't necessarily changed their behavior yet.
Hmm. Yeah, I think, and it's one of those kind of sentiment things as well, is that, these things don't happen when everyone is prepared for them. So that's one of the things, just on a pure intuitive sense. That's why I really love this thesis that I'm putting forward, because it would wrong for absolutely everyone. Everyone's thinking the recession is coming now, inflation's coming back, and it's the opposite. You're going to get deflation, you're going to get a massive euphoric move in risk assets, and then that's probably going to be the euphoria where you should be turning really bearish, because that's going to wrong foot everyone. Everyone's going to be making money on NFTs and meme coins, and in the background, deflation is causing is brewing a storm, and so I think that would be a really just classic market move of just wrong footing everyone to both extremes.
Yeah, I think I always think back to like 2008 was the biotechs were so beaten down that the whole market was was crashing it in sequence except for the biotechs. They were
Hmm.
putting in some of their best prints and were really early to the recovery. The small caps might be that version of the sector. I kind of thought it would be a couple of years ago. I was thinking it would be like the solar stocks or something that
Hmm.
we're getting really beat up. I noticed that like Canopy growth, the pot stocks have been killed the last couple of years, and Canopy was having a pretty good day today. So
Yeah, it's that's I've been looking at that as well. FSLR is it looks like it wants to have a wave five, which again is not something you would see in a risk off environment. The XBI chart looks horrific, but it's the same setup as the as IWM is you've had the A wave correction, you've had the B come back down, and now you're probably going to get the C wave. And those C waves can be the most aggressive like it's in a corrective move, but it's often really powerful. So I think it's going to catch a lot of people off guard, and you're going to see things, the underperformers, the laggers like the XBI, the biotech. You're probably going to see it with KRE too, and I wouldn't be surprised to see the solar names come back. They're so sensitive to interest rates, so that's essentially where I would be looking is anything that has that interest rate sensitivity to them. They're the ones that are really going to benefit over the next few months, I think.
Mhm. the maybe it's a scenario too where if some things are if there's more populist positioning and a bit more isolation from the U.S. That some of those U.S. small caps can compete where they wouldn't have been price competitive before.
Hmm.
Could be the scenario. Interesting.
Yeah, I don't think it's necessarily bad for small caps, the tariffs. I mean, it's annoying logistically, sure, with all these rules that are up in the air. But if you think about deflation, it's bringing their costs down. You're going to get yields down, which is going to bring rents down. It's going to make it a lot easier to get credit. So it's actually the macro picture is actually beneficial for them in my opinion, which sounds kind of counterintuitive to the whole Trump tariff narrative. You would think that would hurt small businesses the most, but that's not what we're seeing. The ones that are getting hurt the most is the Mag 7. They're getting absolutely destroyed. They got hit the hardest out of everyone on this move because of those, I think, economies of scale. And I think there was a lot of the carry trade that blew up. I think that's something else that I'm realizing is that carry trade is enormous, and that is focused on Mag 7. So when you get this, Japanese yen strength, there's a disproportionate selling that happens in the Mag 7 because the carry trade is really blowing up as the FX blows up and as the spread kind of changes. So they're all things as well, bearing in mind that if deflation does come further down the line in Q3, that's a major tail risk for markets, in my opinion, is the carry trade. I don't even think we can put a number on how big that is. No one really knows.
Yeah, it's because it's layers into an expansion where proceeds are used as collateral for more borrowing.
Yeah, that's why I titled this the credit Ponzi because that is that is the lifeblood of this system. But that works both ways, like that's gonna cause a lot of trouble, I think, when that starts to unwind. I think we've just had a little teaser. I think August last year, and what we've just seen. I put up some charts as well on my Twitter. You can see the clear correlation. Once the Japanese yen breaks out, that's when you get this forced selling on the Mag 7.
Mhm.
I don't even think we can comprehend how big that is. With all the, like you say, the layers on top of layers, and because the thing I never realized until relatively recently was that they when for example when the spread is reduced because whatever the Japanese central bank is doing or the FX rate changes, you would think like a normal person they would not put the trade back on, but that's not what they're like. They put it on with more leverage.
Mhm.
Like that's the mentality. So because they want to get the same spread, which is similar to what they were doing with the basis trade, looking at 100x leverage, and that's not sustainable. So, if we're going into this more volatile environment where Trump can say something and it blows out FX in many different currency pairs, it's going to cause havoc. It's going to cause absolute havoc, and then you put deflation on top of that. It's a debt-based system. Do you know what I mean? Like there's so much fuel there for disaster, and that's really this is my exit strategy. My focus now is on small caps, Bitcoin, crypto, try and make as much money as possible in the next 3 months, build as much cash as possible, and sit back and let it all unravel over Q3. I think I really like that. I never heard of that idea of how you you're not doing anything for 6 months in the presidential year between May and October, because that's essentially my plan. Come June, I'm out of the market, and I'm just tactically shorting things.
Yeah, and my and Beth's got a good question here about an analog between 2018 and 2025 in the chat. And so is she's saying, we're thinking a bit sooner, like for than September for a rollover, like June, July. So I'm thinking that that we know that we've got a few news catalysts, and we know that we have a lot of we've got at least like 20% of the nation's debt maturing,
Hmm.
treasuries maturing, and that'll roll over. I think there'll be some price pressure and rate pressure that pushes them like in between there. And I'm just not convinced. Like I just don't know if it's responsible to expect um like a broad surge in the market in July like we would normally see. I'm thinking it will be something more tactical, and
Yeah,
that's why my preference is to sit out and wait for the fall indication. But then we could,
yeah.
could also wind up in a situation where if it doesn't improve, then you get the fall panics. But um, yeah, I'm very cautious on it unless we see some really clear indications that we have trend that we should follow. Um,
I
I
think
would
July is
comment,
going to be that transition. Yeah.
mhm.
I would comment, Ben, you showed those refinancing levels that we're facing this year, which I think are fairly dramatic. And I think, one of the things that I think is you can draw a line through with what Trump and Bessent have been saying is we're going to drive oil price down and we want lower rates so they can refinance the debt at a lower rate. I think that is the
100%.
one line that is held consistent through all of this craziness. That line has held consistently. And I think it
Absolutely.
maps nicely to what Sonny has discussed here in that I think they're engineering this. I think they
Yeah.
want this to happen. That says, gold and things should spike as that kind of goes through that process. And they're going to try to refinance a ton of debt at a lower rate. I mean, that's their one big complaint against Janet Yellen is she didn't refinance when the rates were low. And we're now paying off interest at, an unaffordable rate. So I think that, what that says about the financial markets is another question, but I do think that's what they're trying to do. They're trying to
I think
re-engineer
it's
the debt.
patently clear now, isn't it? I think you hit the nail on the head, and it was so interesting for for my thesis to flesh out in this organic way, where I was picking up on this move that was coming back in January for yields and the dollar, and driven by oil. I could see oil was in this massive descending triangle, and that it was looking very ominous that it was going to break down, and I was really like thinking hard about what these catalysts were going to be. Was it going to be the war in Iran? Was it going to be Russia coming back into the international market? And then what happened was Trump went to Saudi Arabia for peace talks, and then a week later, OPEC decided to increase supply, and I was like, oh, cheeky such and such, like he's that there was no coincidence. Literally a week after going to Saudi under the guise of peace talks, OPEC's increasing the supply of oil. Right, okay.
Yeah.
So
Surprise,
and then you had
surprise.
you had a big move down that week. It didn't break any high time frame structure, but it did help it along its way. And then I wouldn't be surprised if that's why the tariff rhetoric cranked up a notch or two, because oil was really sticky. It wasn't really breaking. It was really hanging on in there. And then he just done the tariff Hulk smash, and that just absolutely broke that high time frame support. And I think that's it now. I think that's why he's took his foot off the gas with the tariff talk, because he's done the damage. It's very hard for oil to recover from that now. You've gone into a different range on the high time frame, so I think he's kind of set things in motion now. And when you understand it from that perspective, it's perfect for them. They're going to refinance all the debt. The yields are going to come down over the next 3 4 months. They refinance everything. They'll get a controlled demolition. They'll get a credit event that will freak everyone out and think it's the end. At the end of the day, the Fed put is still going to be there. Quantitative easing will be stepping in to fix whatever problems happen in the market. And he just in and all he's going to end up doing by that is reinflating the whole system, which is exactly what my macro count for oil and yield says, is that you've got a macro wave three coming after this. That means massive reflation of everything, commodities. You got inflation's going to come back in a bad way, and the way that's going to happen is probably through some kind of quantitative easing bazooka in the face of some credit event.
Feel very cheery now.
Oh, I think as a trader, it presents me with like incredible opportunity. All I've got to do is understand these cross currents, pick the right market, sit back, wait for the chaos, and then pick up the pieces as it's falling out, and you start to see that macro policy emerge of, the Fed have already said it. They got to close to, they've already hinted at it when this catastrophe happened. They turned around and said, oh, we have tools in our toolkit. They're going to step in. So you just, for me now, I've got over the morality of it all. And for me, you just swim alongside them, with a remora, and they're the sharks. You just got to swim alongside them, and that's the game we play.
And it's almost like the remora swims from shark to shark, and that's why we want to be composed, we want to be flexible to what the market shows us. These big downturns, there's always opportunity somewhere. It could be something international, it could be a change in asset class from commodities to different types of equities to crypto to forex. Like, we just have to be open-minded and creative, and we don't always have to identify it early. We just have to be ready to change when we see it.
Who are you looking at? I mean, I see you list Mara on your
Hmm.
your Bitcoin list or your Bitminers list. I mean, they have definitely taken a pretty big haircut from 6 months ago.
Yeah.
They're all probably at 30% of where they were. Um, and your notes here would suggest that you're going to get a pretty big reflation of the bit miners, maybe
Yeah,
maybe more so than a Bitcoin climb.
yeah, they should start to outperform Bitcoin by a substantial margin now. They're in the same risk category as the altcoins. They're all driven by the same macro forces. So you can't have an environment where Mara goes up, where yields are above 4 or 5%. It's just not possible. You don't have the liquidity in the system. The system's too tight. You need this unraveling of liquidity and financial conditions for them to run, because it's a pure speculative play. There's no other way about it. And it lines up so perfectly when you see that the first time when Mara had that run in at the end of 2023, that was when the Fed pivoted, right? And you had that massive slingshot of financial conditions going from extremely tight to suddenly extremely, not extremely loose, but relatively speaking, much looser. That rate of change was massive. And is that a surprise that, Mara went parabolic during that time? It's just the way the market goes. That's why it's underperformed for so long and left everyone so confused. And this is what I caught on to recently with the IWM, because I'll go back to it briefly here just to explain what I'm talking about. Everyone's been so confused in the altcoin kind of crypto market as well. Like, things haven't quite performed the same way they have in other cycles, and it's obvious why. We're IWM is in a bear market. Same with bonds. The generation of easy money. This is the last time you will have easy money on this, as yields come back down to probably 2%. This is the last time you'll have easy money and this kind of speculative euphoria. I think we're in a shift change where you're going to go from this kind of easy money. This is already the change and of regime that's happening. So you're not going to live in that world anymore. So after this, Bitcoin miners, altcoins, they're all going to die a horrible, horrible death if I'm right about this IWM count, because you're going into a very severe bear market where you're probably going to get a flight to quality. Bitcoin will probably survive pretty well because it's actually kind of, it has fundamentals. But yeah, anything that's got of a speculative nature is, it's only going to be good for shorting for the next few years after this hype train kind of. This is the last hurrah, basically. That's the way I see it. This is the last hurrah for speculation, for easy money, and this kind of, just euphoria of liquidity that we've become so accustomed to. It's been so normalized in markets now, and people have been umming and ahhing why the Bitcoin miners haven't performed, et cetera, et cetera. And it's because of this chart. Like, you can't have Bitcoin miners performing when you've got this horrible, disgusting corrective structure. When you go back and look at this chart, this is when they performed the vicious wave five. They all done, God knows, 20, 30x in a very short space of time here. This was obviously the massive bull run for crypto at this time. This is not a coincidence for me. IWM is at the end of the risk curve, just like, you've got your altcoins and your crypto market is at the end of the risk curve. So for me, this is kind of the end of the risk curve. I'm not saying they're not going to have moments in the future, but this is the end of that speculative mania, in my opinion.
What do you think of gold? You've spoken about Bitcoin, but what about the gold market in the short and medium term?
Yeah, so what you usually find is that once gold goes parabolic and it reaches its top, that money starts to rotate into Bitcoin, and that fits really nicely now. From my Elliott wave count, that's reached a pretty clean 5 wave move. So I expect that to fall in the short term quite fast as the market pivots to risk on and the fears around tariffs and everything kind of die down. It's a question. The longer term question on gold for me is more about how deeply Besant and Trump are going to change the financial system. I don't know if you saw Besant's recent, I think it was yesterday, his speech, and he had a bit of a Freudian slip about we're going to reconstruct the IMF. So they're planning something in the background. That's why central banks around the world are voraciously buying gold. It's obviously been an incredible run, but I think, yeah, in the short term, time for some of that money to flow into Bitcoin as a rotational play. But I think come like Q3, I think you probably want to buy that dip in gold. Yeah.
But that's what I'm thinking as well. So the thing I'm trying to keep in mind is something that Tom McClellan posted about commodities and commodity futures, and we talked about this the other day. So the participants that buy futures contracts of commodities all the time do it for a business purpose. independent of the technical levels. And then the speculators, will get in and they'll do things, and they'll have an influence on the market, and they'll move around based on the technical levels. But then they'll wonder, why indicators or measured ranges and things that aren't working in commodities, and if the participants still need, if the core participants in commodity future contract need to, you still need to buy it, still need to operate with it, they can continue to run that price higher, independent of how speculators and traders will manage things. And we could see that with gold, where we hit this technical extension, the speculators, myself included, taking profit, exiting, but central banks, if they feel like they still have a risk to hedge, are going to continue adding gold until they're comfortable that they've hedged it. And then as soon as that risk is gone, they're going to sell it. Or as soon as that risk materializes, like increasing commodity costs, they'll have to liquidate that gold to they're using it to fortify their currencies and their balance sheets now, but when the risk presents itself and they have to liquidate gold to help to help fund inputs to production and products in their economies, that they'll do so, and that'll take place independent of technical levels that we would identify as traders and speculators too. So I do think we could see it roll down a little bit, but it'll be an opportunity to continue to continue to participate with it until we know that central banks are doing something different.
And I don't think they're going to stop anytime soon. I feel it really felt like this was a moment of letting the air out of gold. Like you had that really long accumulation, and then the kind of air was let out. And I think it will come back down and consolidate again. And then whenever that sort of critical mass is hit again, it will let the air go out. I think it will be a massive trade for a long time to come, especially because like I'm even questioning my own technical analysis on it with the Elliott wave, because I'm aware that it could just be a series of 1, 2 extensions as a nesting process if that appetite remains there from central banks, because there is no bigger buyer than central banks, especially if they're going to start, QE and inflating their currency even more. They're going to need it more and more in the background to kind of justify this imbalance, that they're working off of. So I think it's going to become such an important part of everyone's portfolio over the next 5 years that you can't really ignore it. I think this year was the last 2 years it's kind of breakthrough, really. It kind of blew all the narratives out the window of, oh, it doesn't do anything and blah blah blah. I think that's telling us there is a regime change underway, and we're probably not privy to all of the ways behind the closed doors that it's changing. I'm still kind of trying to wrap my brain around it as to how gold fits into everything and how they're trying to use it. It's very obvious that China is trying to defend their currency against gold, not necessarily against the dollar. That's the real thing that's the real kind of North Star, the thing that matters. So I really don't see that changing anytime soon.
But isn't buying gold also a hedge against weakening of the dollar?
I don't necessarily see it like that. I mean, yes. If in statist like from as Michael Howe says, I suppose it is like it tracks that rate of change, right, very well. Like say the inflation rate is, I think it's like, I forget what the standing rate is, but let's just say it's like 8%. Gold tends to match that. So you're is that a hedge? I guess that's I don't really like that kind of nomenclature, because is it a hedge? Like you're just staying with the inflation rate. So I guess it's better than cash for a very long term time horizon, but I want to be doing better than the inflation rate. Like that, the inflation rate is my hurdle rate. I want to be doing better than that. I don't know if I just want to keep pace with the inflation, if that makes sense. So I don't know if that will change too. I don't know if now like gold is becoming more accepted, and as part of like a global strategy, and maybe now they're not. They're letting the air run of it out of it. Like I say, like a lot of the gold was suppressed because of the paper contracts, and we've not really seen that. Like they really let it run. Like it's really been quite a historic run in the last couple of years. So yeah, it's interesting. I put my tinfoil hat on a little bit. Like are they letting it run? I don't know. Are they going to revalue gold at some point? I think we have to be open to that possibility, like they did many decades ago, and revalue gold at some point. I mean, that would be one way to pay off your debt.
Yeah, that's so it's a good question because you, internationally gold is priced in US dollars, so the virtue of that math, does make it a hedge against US dollar devaluation in addition to any other value or speculation. But then I guess the risk is if the international monetary systems are changed in a way that gold is priced out, priced in other ways than US dollar, then yeah, that would change the value for us as like US participants.
And that's what you're seeing, right? Is like there's obviously a big change coming, that's already happened. That's why gold has run, right? Like from a macro perspective, they reclassified it to a level one tier one collateral. Like that's huge. So like that's a massive green light.
But if
Which, sorry, go on.
no, if I was, say, a European or Asian central bank, and I was sitting with a lot of dollars,
Hmm.
I would consider hedging it with buying gold, I would think, to
Yeah,
secure the dollar position.
what are you hedging? I think it's better than that. I think that's why I'm questioning that word. Is like I think it's deeper than that. I don't think it's just a hedge against inflation. I think you're looking at an asset that is potentially going to underpin the system at some point when they're ready. And um, I think it's even more powerful than just a hedge against inflation. Like historically it has been, but I think with this reclassification, I think that gives gold so much more potential that I don't think most of us have really, and me myself included, I've not really sort of caught on to how much of a regime shift is actually happening, if that makes sense. I think it's definitely a hedge against treasuries. I think that's the one thing that that's another target market that it's gonna consume over the next 5 years. Is people are not going to hold treasuries anymore. People are not going to hold long-term US debt instruments anymore because they're going to be in a very vicious bear market. So I think that's what you're seeing, right? I don't know if you've seen the chart of the gold price mapped onto the yields, and mark the date where they seized the Russian reserves. Wow, that's when gold really kicked off. I don't think that's a coincidence. So I don't think it's a hedge against necessarily the US dollar. So by proxy it is, but it's more a hedge against treasuries, against the bond market. That's kind of where I see it sitting in portfolios. Is there's no incentive to have bonds in your portfolio. The maths doesn't stack up. So I think that's where gold is now going to a new level, and probably being allocated as a certain percentage of what treasuries used to be in someone's portfolio.
Uh, it's interesting. I guess the counter to that would be that if the US is too threatened on treasuries, they have the US holds enough gold to potentially disrupt the gold market by selling. But yeah, not sure. I'm not sure that it would actually get that far.
There's something going on. I mean, they shipped all their gold from London. The London vaults were basically empty. It took 6 weeks to get your gold over to America. It should only take one week. They're there is something going on under the surface that we're not that we're not quite seeing yet. And once it comes to fruition, it will be obvious. But yeah, I just I haven't put it all together yet. But I think gold is in the process of a massive regime change where
Mhm.
it's probably not just a hedge against the dollar anymore. It's actually becoming an integral part of the global economic system in a way that it hasn't been for nearly 100 years. Yeah, about 100 years. So remains to be seen how that plays out. But it's definitely one to watch, and I think very wise to start including that in your portfolio when you get those dips that are available. Especially as you've seen that it can even play as some kind of beta in these moments where what's performed over the last 3 months, nothing except gold. So I think it gives you at least it gives you that kind of uncorrelated aspect within your own portfolio.
So, and um, I did see the comment from Jordan Lindsay the one day too that and I've heard others say it, but that gold is like it's similar to Bitcoin. It's an asset that you want to buy and hold and not sell. Now I'll trade it, so and I trade Bitcoin as well, but it's now a it's now an asset that I'll always permanently have some of, and I'll continue to trade it, but it's one I lean towards long-term accumulation, even after it hits its top and goes into a bear market. I'll still hold it.
Absolutely, and I think that's a natural consequence of understanding this system. Like as I started the presentation, like once you understand the debt-based nature of it all, it's just common sense to be an advocate for those kind of sound money fundamental principles because especially if something as I've suggested does play out where there's a credit event and then the QE starts again in even bigger fashion than COVID. Yeah, there's gonna things are gonna get really silly at that point. And how do you protect your purchasing power? You're gonna have your hurdle rate for trading is gonna get higher and higher. So yeah, if you can take advantage of those like long term troughs in either Bitcoin or gold, yeah, it's very important to do that. And there's obviously this clear relationship between the two, which is very interesting. Like how there's this rotational play between them. Gold is the leader, and then you get this kind of rotation into Bitcoin. So I'll be very surprised if there's not a financial system in the future, which is a big part of gold and Bitcoin.
Yeah, I agree. And so when I look at the common flow of funds through assets is treasuries, then equities, then commodities, and then U.S. dollar index. And I layer Bitcoin in between treasuries and equities and gold in between equities and commodities. And so if gold goes, what happens after gold goes up is we're either going to go back into speculation, which favors crypto and Bitcoin first, and then equities, or it's truly risk off and commodity prices start to increase, and we'll see commodities pick up while gold is still high. And so it's a really good the relationship helps a lot with directional planning. Johnny asked a question about silver. Sonny, do you do much analysis with silver?
Yeah, I keep on top of all the commodities. I've got wave counts for all of them. The way I understand silver and the relationship with gold, obviously silver's relative to gold. Silver took an absolute beating, but it was so close to breaking out in February, March, and it wasn't really until markets started to fall apart that ratio also turned into a bit of a disaster. But for me, that's another risk-on signal. Like I look a lot at copper and gold as another sort of growth versus defensive metric, and silver versus gold would be another one of those. So um, that would be something I would be looking for as confluence for what I've presented today is silver starting to gain ground on gold, and I think there's a good potential for that. It's definitely built a parabolic structure, and given gold has reached probably a local top for at least a few months or so, probably do see that rotation into silver. It's just silver's a weird one, isn't it? It has its moments where it runs, but then it can be extremely frustrating at times. And I do think it gets up to $50 probably this year. But yeah, it's hard to trust a lot of the commodity markets for that same reason I said earlier, with all the suppression and the paper contracts, and um, that's why I'm kind of with my tinfoil hat speculating a little bit. Are they letting gold run right now? Does it suit them to run now?
Mm.
Because for so many years, you would just see it get smashed on Monday for no reason, and now they seem to be really, reclassifying it. So I think gold is in a different, completely different realm to silver. I don't know. I think silver lost its monetary value a long time ago. I'm sure that narrative will come back as it starts to perform well, just like we see with many narratives. They revive themselves when the price starts to justify it. But I'm not really sure how I sit on a fundamental basis with silver. Obviously, it's a very important industrial metal for everything that we need in the world, especially with electric vehicles, solar panels. So it's not going anywhere. And especially if there is a reflation of the economy over the next 4 or 5 years, then it probably benefits from that too. Um, so yeah, I think it has a potential kind of beta role to play versus gold potentially in the portfolio. But is the case for it as strong as it is for gold right now? Definitely not, in my opinion.
But I just pulled up the last update from my silver chart. What where I struggle with silver is I don't follow it very closely, and it's one of those assets that tends to burn people that aren't familiar with it.
Yeah.
But this series of higher lows, we've got going on. It's above. So I'm looking at a weekly chart of it, and it just keeps breaking above its anchored VWAP. So it came back down to test the one from where we had the gap up in March of 2024 on the weekly candle, and then it's up into the kind of come up to consolidate and test in between the 1.272 and the 1.414, and that's like an area where in trending assets I'll see them like run into a little bit of resistance here, but then once they break above it and come back down, once we get above this 1.414 and then come down and retest it, like that's where I would look for silver to make its next move up, and then probably up into like the 2 to the 2618 at least. But I tend to forecast those like kind of conservatively, but it's definitely
It's building a nice base, that's for sure.
yeah.
Like I don't think it's a bad point to start dipping your toe in the water. Like I say, if we do go risk on over the next few months, and copper starts getting going, and we start seeing that manufacturing impulse come back into markets, with the easing of financial conditions, they're conditions that silver really really likes. If you think back to kind of what I showed with the last time we had this kind of switch between the Mag 7 and the small cap growth, that was the same time that silver went really silly, was around kind of Q4 2020 and Q1 2021. You had, everyone on Reddit talking about short gamma short squeezes and everything, and it shot up to $30 from like the low 20s. So I think it benefits from those same macro forces that I discussed in my presentation.
Yeah, and I like the follow through in on balance volume. That's remained high and rising, even though we had the end of March into the beginning of April, that large drawdown on the weekly candle, it came down and it hasn't fallen through the AVWAP from from March of 2024. So it's showing some good signs. I would want to see it get above th about $30 67 cents on the SLV Silver Trust. That would be a good sign. It's a tough one though too, because where copper is so for me personally, and it was like it doesn't have quite as many, quite as broad of my perception. It doesn't have quite as broad of industrial demand as copper does, whereas like copper's less used as a monetary asset and more as
Hmm.
an industrial input. Like silver's got a kind of a leg in both.
That's why it kind of has weird cycles, I think, but it doesn't really know what it is, you know. It's
Or
like
too
you've got the
many.
clear dichotomy between
Yeah,
copper and gold, but then when you throw silver in, it's like the middle child, you know?
yeah, like too many people getting involved in it with or too many participants involved with different narratives for it, I think. Um,
Yeah.
that kind of leads to that. Looking at your Bitcoin miner, um, and just taking a look at like just the Bitcoin mining ETF, and
We are going to make it. Yeah.
yeah,
Yeah.
this looks pretty good as well. It's recovering. It's now above the you've had a series of failures on AV WAPs from the prior highs, and that tells you that the market's full of people who regret the last time that they bought it on a rally, that are looking to cut their losses. And then once
Can you
you
share your screen, mate? Sorry to
oh, it
interrupt.
might is
Yeah,
my
I can't see it.
you
Or is
can't see
it
it?
because I'm sharing mine still?
Oh, we both sharing them at the same time.
Actually,
Let me see if there we go. Yes, here's the
there we go. Nice, thanks.
yeah, here was the silver chart on the weekly. Where we're kind of like trapped in the 1272 and the 1414. And
Hmm.
and then on the minor ETF, so you've got look at this on the daily since it's close enough. These failures into AV apps from prior high, like you come up, you test it, you fail, you anchor a new one, and then how the market behaves against that new one tells you whether you've got participants that are aggressively selling and looking to cut losses, or if they're now you've got buyers stepping in above and beyond the sellers. And so you've got this break above for the first time in a little while, and then your unbalanced volume is breaking above the trend line while the volatility MACD has a bullish crossover. So it's number of favorable signs coming together at one time on just the sector of
Yeah.
Bitcoin miners.
Yeah, definitely one to watch. For it's not going to be one for the faint-hearted, that's for sure. So,
Yeah.
before I go in any size, I'll probably wait for the higher low, kind of early first week in May, going into the Fed meeting, something like that. Try and start accumulating there. I think it's going to have a really nice push over the next few days because Bitcoin is recovering levels quite fast as well. So, but yeah, that's a nice observation. It could be a sign of like a little bit of a trend change there that it's going to start building again because it's a bit of an ugly chart on the higher
Mm.
time frame. Just it's been such a horrible one to trade. I've stayed away from it for a little while. It's just been chopping everyone up.
Yeah, interesting volume here. You get this like high volume um, into a short range candle, and then it retakes the AVU up the next day. So probably see some, miners probably see some overhead selling for a little bit, but if they power through this, it's gonna be a ripper.
Yeah, I think so. If there was ever a time, I think it's now with a macro backdrop and micro strategy looks like an absolute beast. Have Have you seen the MicroStrategy BTC chart?
No, not in a little while.
Check that out. There's a massive cup and handle that is broken out on the weekly of the. Oh, you got a typo.
Oh, oops. Oh, so, wow, that looks like shit.
There we go.
Oh yeah, there we go.
It's already broken out.
Yeah, and again, like look at this balance volume is really showing a lot of support against this trend line while it's doing this. Yeah, that looks great.
Because it's never they that last high was before they had actually bought Bitcoin. So this is like uncharted territory for them, you
Yeah.
know. To flip that level is really big to make a higher high. So that was a real tell for me these last few weeks that something's happening there. If MicroStrategy's not finished, then risk on environment is definitely not finished if that's got more juice in it.
Yeah, absolutely. Yeah, that looks really strong. Yeah. What about anybody else from the group? Anything that we want to take a look at? Anything cool on anybody's radar? One's you. Unity software. Oh, I thought I had a chart on this one. So yeah, we take a look at. Have you charted Unity software before, Sonny?
No, I've never looked at it before.
Oops. Let's take a look. Um, right, so looking at on a weekly from a momentum crossover. Get my my magnet back on. But yeah, I would say, I would look for it to be I'd like to see it get above, 3170 before I'd be interested. That would be confirmation that at least on the weekly that it's got a trend recovery. And to do something like that, you'd probably be looking at like a um let's see how it looks against the AV bot from all-time high. So you've got these couple of failed attempts at the AV bot from all-time high, and that's now trending towards your 382. So it'll probably come up there, give you a little bit of resistance, and then a break through that area would be great confirmation that we're headed higher. And like maybe in like a fashion like something like this, get up to your 618, maybe even, if there's not, because once you clear this level, there's not much overhead resistance. So you could even wind up at like your 786 and then potentially a test of like a new high or something like that.
You got big resistance there at $40, but once you get above that, it's
Yeah.
pretty yeah, it's pretty much fresh air above $40. But it's trying to turn the corner, isn't it? It's not the cleanest bottom that I've ever seen in my life, but it's definitely it's trying to put in a bottom for sure.
Yeah, and like look at all this volume concentrated. Like once I see like multiple things concentrating on towards a key fib level, that becomes like the
Hmm.
springboard once you get away from it. So it could be interesting. Yeah. And then Beth asked about NVIDIA. We were just going through the NVIDIA chart the other day.
Yeah, this is a straight up be patient and wait to short the pop, I think, in my humble opinion. I'm not, I was just telling Ben earlier offline that I'm not touching semis with a barge pole for the next few months. As from my count, this is the B wave, so I'm expecting a bit of a bull trap over the next few months. Really, I wouldn't trust any rally on Nvidia. It
So
looks it looks like a very clean distribution pattern that's already formed and will continue to form. That's you're seeing so many fake outs above the highs. That's usually quite a clear indication that, they're it's in a distributive process. And I think if you get back up to that 1.618 at the 136.99, if you start touching that again, oh my God, that's pure danger signs. That's just a straight up short for me.
Yeah, I think, so I played this, I set this chart up based on and it's kind of scrunched in, so I apologize for that, but this was based on um, the analog from the 2021 split and the time frames and taking the fib time zones from where we see swing high and swing low in between the split being announced and the stock split. And then it makes a proportionally like measured move. And then once you get like 100, I think it was like 120 days past it, was when it started to draw down like this and went into like an ABC decline. Then we really got the same pattern, a very similar pattern and time frame with the 2024 split. And so you've got the split announcement is here. You've had your first pullback there, and then the Fibonacci time zones all started to converge around the towards the December 2024 timeframe, and that's when I started to get out of it. And I'm like I still have a position. I'm still long the business model at NVIDIA, but as far as like a very large position or something that I would add new money to, I'm going to wait until probably we get more towards the end of this year to consider it. Would line up to a situation very similar to what we saw um, from the peak in 2021 through the low in 2022. And then this comes back to that. I apologize for tabbing through so much, but this comes back to that overall
Yeah.
semiconductor cycle. And this is the one that Rick has shared a number of times. And it's interesting to see the RSI coming down and making this low, like coming very close to the lower trend line within the shorter harmonic of the overall cycle. The last time it did that was at the beginning, like when these trend lines establish. And so we've been in a mode of underperformance for semiconductors relative to the S&P is the light purple. And so this tells us that the broader market's outperforming semis during these transitions. And then when we cross that threshold, which comes up in May 12th, is when we've seen the broader market and semis retrace and form a low, within between like 8 and 10 months. So that lines up with me starting to consider NVIDIA and just semis in general, probably I'd say probably the end of this year, early part of next year. But it still has Broadcom's still going to be like a top three position for me. I own too much of it at a very low cost, so I'm just going to leave that alone. Um, after
Yeah, I think that's wise. I don't think that you need to, if you're taking a long-term perspective, I don't think you need to panic. It's just a matter of it needs to reset. It had a
yeah.
very strong peak back in July, and the euphoria around semis at that time was so indicative of a macro top, and the technicals say
Mm.
that too. So doesn't mean you can't play long on a shorter time frame. I think you're probably going to get a nice pop over the coming days, but it's already looking very corrective in nature. It doesn't look like it's ready to start a new high time frame trend move, in my opinion.
Now I've taken the what I have in NVIDIA um, in my current NVIDIA position, and I'll sell options like sell covered calls above these descending AV WAPs and into months where there's seasonal weakness. So I've done a bunch of covered calls into like 140, 150. You do it on days where it's having an up day and you can get a better option premium for it. But that's I'm looking at that as like very low likelihood of the option being executed. And as soon as I set the option, sell the covered call, I'll set a buy to close at 85, 90% profit. And I just keep rinsing and repeating. Um, but yeah, it's not an area where I'm personally comfortable adding net new money yet.
No, definitely not. Anything else anyone would like to see?
Yeah, that's good. That's quite a bit tonight. We're almost at like 2 hours. Sonny, I really appreciate you spending this much time with us. We're gonna
No,
have
pleasure. Thanks so much for having me.
Yeah, I'm gonna do some edits on the recording just to give us like a clean start for it. So we'll have that um up on the Substack, and then it'll post to YouTube automatically. So we'll get that link to you, and then to be able to share with the folks that follow you. But
Awesome. Fantastic.
yeah, this was great. I'd love to do another one sometime. Let me get your info back on the screen here. I don't know if I might not be able to do it. There we go. Yeah, so if you guys didn't grab it earlier, be sure to follow Sonny on X. He's posting great charts and usually like lengthy threads with his thoughts on how assets are related and confirmation for what he's seeing, or changes as he comes across them. So definitely follow him, and Sonny, thanks again for your time tonight, and appreciate everybody's participation and questions and comments. It's been great.
Yeah, thank you very much, Ben. Really appreciate it. And thanks for everyone for dropping by.
Awesome.
Thank you very much.
All right. Thanks, guys. Have a great night.
Take care.